Welcome to KPMG's Clarity in the Boardroom. I'm Arianne Alcorta, and today we're talking about the uncertain future of Swiss private banking. I'm here with Christian Hinterman from KPMG. And Christian, KPMG just released its latest report. It basically states that 1/3 of all Swiss private banks are at risk of going out of business.
And when you look at the chart, you can see the number of Swiss private banks came already down from 163 in 2010 to about 100 in 2019. And with more than 50% of the smaller private banks below 5 billion assets under management disappearing over the last 8 years, and many of them showing very poor performances, we assume this number will go down significantly over the coming years.
Okay, well, that's interesting. And given that 2/3 of poor performing banks are actually small banks, as we can see and hear, are you expecting consolidation to accelerate?
Yeah, I mean, very clearly, you can see the number of small banks that are weak performers doubled in 2018. Their performance really dropped significantly. Therefore, yes, an acceleration of consolidation has to be expected.
What actions should they implement in order to survive in this industry?
Many of them can hardly attract new customers. So net new money, the number and assets under management of new customers is at a very low level. Many of these banks even lose customers every year.
Especially because, according to your report, assets under management in the Swiss private banking industry is very directly proportionate to the global equity markets, right? And that really exposes how vulnerable these banks really are.
Many of these banks have not really invested in their business over the past few years because they were already in pretty bad shape. So they are lacking new banking systems, a modern product and service offering. They have very often weak asset management capabilities, which is in the new world of tax transparent private banking a must, that you can prove your clients that you bring good performance for them.
And what about medium-sized banks? We know that they have gone through the similar difficulties during the past years, but the way that they have tackled it, or the way that they have postponed their decline, has been by cutting operational costs. But how much longer can they hold on, or can they postpone this before they start suffering from the lack of investment?
It's actually quite interesting. As you said, I mean, the medium-sized banks were the only banks that were able to cut their operating costs in 2018. So in principle, of course, that's positive. But at the same time, you can see the income decreased at the higher pace. So this is not the sustainable model. This is a defensive model. The question is, how can they really, yes, control costs, but at the same time, like the large banks, also grow the business again? And what we see there, the large banks, they have local presence in many countries, so they're close to their customers. And as a medium-sized bank, it's a challenge. It's too costly to have local presence in many countries.
And Christian, to attract this new client, do you think that we need to shake up management a little bit? Do we need to change this? How urgent do you see this need in the banking industry?
It was amazing to see how the average age of these boards and executive committees actually was constantly increasing over the last years. It's somewhere in the high 50s, increasing. And then secondly, what you also see here, the percentage of women in boards and executive committees is really small. Nearly half of the banks had no CEO change in the last 7 or 8 years, despite poor performance. Therefore, yes, very clearly, I think a shakeup is needed in the board to really push this transformation in the private banking industry that is needed. So more fresh blood, more women in the boards.
Well, that's definitely great to know. Thank you so much, Christian, for coming, and thank you all for watching.